Hello and welcome to this week's instalment of Nucleus Investment Insights. Well, it's a pivotal day for both USA and perhaps the world, as incoming President Joseph Robinette Biden took the stage overnight in the inauguration of the 46th President of the United States of America. Rarely has a new American president faced challenges as formidable as those Joe Biden must now confront. Their economy is slammed by a still uncontained pandemic. There remains an executive branch crippled by 4 years of mismanagement and malfeasance, and the transition must deal with the outgoing president's second impeachment. But gravest of all, the country is so bitterly at odds with itself that the risk of civil disorder is very real. President Joe plans to begin by immediately unwinding his predecessor's policies on immigration, climate and other issues on Wednesday, including moves to reverse US withdrawals from the Paris Agreement and the World Health Organization, and to stop construction of a border wall. With these changes also comes the promise of 1.9 trillion, so that's a 1, a 9 and 11 zeros after it, in new stimulus to help the economy steady itself as it grapples with overcoming the pandemic. Buoyed with renewed confidence, the S&P 500 index advanced 1.4% to a record, marking its best first-day reaction to an elected president's inauguration since January 20 became the official start of a term in 1937, and topping the 0.34% gain when Donald Trump was inaugurated 4 years ago. So with the major bourses at all-time highs, the question now remains, will it last? Here to share his thoughts on the prospect of a Biden boom or bust, I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Tim.
And back for his first show in 2021, we're also joined by our Chief Strategist, David Llewellyn Smith. Hello, David.
G'day, Tim. Good to be back.
It is indeed. And just a quick reminder that before we get started, if you haven't already, subscribe and click the notification bell to be notified of when we go live or have a new webinar to watch, or follow us on your preferred podcast platform. We also ask if you'd like to take a moment to click like on the video now to help our show grow. And of course, for those listening in live, feel free to drop in your questions in the YouTube live stream chat to have them answered along the way. So let's roll into the agenda for today. We're going to kick off with a Senate impasse or not, stimulus and policies, and a bit of a look at where this 1.9 trillion is headed. We'll then have a look at the current economic environment of the US, and then wrap it all up, as we do in every show, in the investment outlook and how we use these themes every day here at Nucleus Wealth. So to kick it all off, we'll jump into the Senate impasse. Fellas, who'd like to begin?
Is that one more for me? I think probably Dave.
You've been researching that.
Yeah, well, it's so. I'll try and give the simple version of the filibuster for people. It's look, my top down sort of view of really what it is that the you need. So when the US Constitution was put together, it was basically you needed a majority in the Senate to pass things, and then later on they created the rule to try and stop people from talking forever, which was basically if 60. So in the Senate you can basically just keep talking. You can basically just keep topics open and keep asking more questions about them. But if you they created the rule so that
to prevent the passage of legislation.
Yeah, well, initially it was, just you need to examine legislation. So then they created the rule, which is basically, well, if 60 out of the 100 people vote, then they can stop you from talking and asking questions and keeping these open, and you can just get on to the vote. And so initially it was done as just a way to let's just move on. And then eventually what happened was that 100 years later, it then got turned into, well, actually we can use that to block stuff because we can just keep things open until
run the clock out.
Filibuster basically just keep asking questions, and no, we can't vote yet. We've got more. We need to find out more information about it. And then they created it so that and that would basically stop all because the Senate could only be considering one issue at a time. And then they went, okay, well let's create two streams in the Senate so that we can, just in case any of these happen, that we don't sort of block government forever. And so once that happened, that sort of opened the floodgates, and now you can keep using it all the time. There's a few things they've when Obama was in, they were sort of frustrated with that, and so basically because all you need is a majority vote, you can actually vote to sidestep that rule for certain things. So that's what they've done for things to do with the budget and appointments. For that was the main one they did it for when when Obama was president, was that the Republicans were blocking just normal everyday appointments that they were doing, and so so anyway, so they passed that. But what they said was that it didn't apply to Supreme Court justices. When the Republicans got in, then they changed the rules to say, well, we're going to allow it we're now going to allow that you just need a majority vote for Supreme Court justices. So both parties have already sort of gone, well, here's the old tradition, but with just a majority vote, we can put in a new legislation which says we don't have to worry about that for certain things. And so there's nothing really stopping there's nothing really stopping the Democrats from saying, okay, well, we're going to now add the stimulus packages to the things that we can vote on with just a simple majority. I think the initially they'd prefer not to do that, and I think they genuinely would like to try and bring back some bipartisanship. It's just I guess so how you look at the Senate impasse is basically in a few different ways about going, well, does this just mean that Biden will come out and say he wants $2 trillion, and then when he really only wants 1.2 or 1.3, and then he'll just get negotiated back to 1.2 or 3, and they'll put through as bipartisan policy, or is it going to be stymied from the view that potentially the Republicans will try and just block everything and just say, no, we've already had enough stimulus, and now that we're not in power, we're very worried about debts, and we'll just block everything. In which case, that's where the question is: do they go back and use what is called the nuclear option, but it's basically saying, okay, well, we'll just go back to a simple majority, and that'll pass things. And so, I guess so. On that front, do I think there's a Senate impasse? Probably not really. I think they probably will start with a few, they'll overcook things and then try and work it back to something they can negotiate and feel as if, try and be a bit inclusive. But I suspect if say the Republican, sways back to the Trump and goes to being extremely intransigent about any extra stimulus, I do think there's a good chance that they'll just vote to say, okay, well, we're going to effectively change the Senate rules back so that a simple majority gets through.
There is one sort of dark interpretation of this as well, which is if you think that the Democrats are really just the plaything of Wall Street and they're not actually serious about reform of any sort, then they could pretend to try and pass various legislation and then not use any of those mechanisms to get around the filibuster, but throw their hands up and kind of say, well, we did our best, it's the Republicans' fault. Yeah. So that I don't think that's what's coming, but I guess I'm just floating it for the deeply cynical as a possible outcome.
Yes. And so that leads us into what's out there. So what stimulus is coming, and so 950 was sort of already loaded in December, 950 billion, and so that's sort of coming out as we speak, and that's obviously got a bit of life to it still. Biden's got a $1.9 trillion proposal, which we'll go into on the next slide. It's got a few things there. And so, as I was saying before, my guess is that it's 1.9, but he probably wants, I don't know, low ones, and he's happy to negotiate away a few things to give the Republicans what might feel like a win. But the other thing that is a big one coming down the pipeline is infrastructure. And so, we sort of had 4 years of Trump expecting some sort of infrastructure announcement, basically at any stage across the, and it never actually came. But there's a pick a number for those. I think the number's quite high, and it might actually be. You might find it's done by helping states to finance their debt or reduce their borrowing costs or something like that. That actually, in a way, it's not really federal government spending. It's state government spending, but it's state government or local government, but it's enabled by the federal government to get the borrowing costs down or to enable them to actually borrow the money so that there can be quite a large infrastructure campaign. And I do think that's that's probably the key bullish. If that comes out at a $5 or $6 trillion infrastructure push, then regardless of how it's funded, probably not all debt funded by the federal government, but potentially it could be as large as that. Through all the different versions of states and local governments, then that's much more bullish than if it comes out as a few hundred billion of stimulus. So,
Damien, just while we're on the Senate side of things, I guess, and just talking around that, we had a question drop in. Thanks, Sean. So, can Republicans block new legislation even with the Democrat wins in Georgia? And my understanding is that it's a minority holding across the board, isn't it? The Democrats. So, is there potential of that, or is it really just the filibuster tactic is the only thing that they've got in play?
Okay. Well, there's two parts to it. So they've got 50-50 for the votes, and then the vice president's got the casting vote. So if it's 50-50, then the Democrats get the win. The issue is not every in the same way that not every Republican senator is hard right. Not every Democrat is hard left, and there's a number of senators. In particular, one from West Virginia, Machen, I think his name is, who's quite moderate, and so if they try to pass things that are too extreme, then he's not going to vote with them. And then there's a number of others. It's a spectrum, obviously. So I do think there's scope on both sides, and I do think Biden's at least going to try in the initial stages to do some bipartisan stimulus. And the thing to note as well is that when you're spending literally trillions of dollars, it's pretty easy to carve off a few Republican states to
pork barrel.
Just to say, look, okay, well, there's an extra couple $100 billion whatever roads and solar panels and whatever it is coming to your state when you vote for this. And I would think there'd be a number of Republicans who would be amenable to those types of incentives.
Well put.
So that what Damien was talking about before is that the Republicans can use this filibuster bizzo to delay passing stuff in the Senate almost ad infinitum. But what he was saying was that there are basically ways that the Senate can vote around that. So although it's an impediment, it shouldn't stop them. And for instance, the Trump tax cuts, which were his key policy in the first few years of his term, never got the Senate approval. I don't think he had to go around using various unorthodox mechanisms to get that passed. So, but basically, the Democrats should be able to get things through.
Sure. Okay. Very good. We'll jump across to minimum wage.
Yeah. So the first, the infrastructure bill. Oh, actually, sorry. Let me just take one step back.
Sure.
So we've got the first 950. There's 1.9 proposed, so that's going to be in debate over the next couple of months. So you'd think that, and this is very much it's coronavirus targeted stimulus.
Yeah.
So you'd be expecting that by the end of March, that there's some sort of resolution as to, or a lot clearer as to where it's going for that. The infrastructure, hard to say when that's coming. That could be, I guess they've got sort of 2 years where they know they have a majority in both houses, and so it'll be a question about which is more important now. Is the infrastructure more important? They've spoken about getting the minimum wage, basically doubling the minimum wage, and making it a federally mandated minimum wage. And so that's going to be very contentious. For you wouldn't expect, or I'm not expecting much support, if any, from Republicans, and potentially there's even a few Democrats that won't support that. I do think it'd be a good thing for the economy, and those ones do tend to show that that raising minimum wages, if you've got a particularly low minimum wage to start with, and then you raise it, that it actually has a huge benefit in terms of giving the poorest people more money, and then they get out and spend that money and pay down their debts and those effects. If your minimum wage is too high, you start losing some of those benefits. But the minimum wage in the US is not too high. It's very low globally. Bidencare, so he's got a number of changes that he wants to make to the Affordable Care Act. He's also got corporate tax hikes and some tax hikes on individuals who are being paid on high income individuals. And so there's sort of like 4 big tasks there. Can he get all 4 of them done within the 2 years? I don't know. I don't think so. I think some of them are going to be quite contentious. And so it's a question about which are the ones. Where's he going to spend his political capital? I think if he ends up trying to spend his political capital on a tax hike for corporates and for high net worths, that's going to steal a lot of oxygen, and it's not going to be a good thing for the markets. I think if he uses his political capital to chase the infrastructure and say Bidencare, which are probably the ones probably more likely to get a measure of bipartisan support, then I think they're both quite positive for the markets, and quite positive for the markets.
I mean, in terms of the business cycle, we're still in the pandemic. The vaccines are rolling out, and by mid-year there'll be roughly 100 million vaccinated Americans, which is going to trigger something of a recovery boom. But right now, the economy is still struggling, and so they're obviously going to prioritise, I would have thought, the stimulus style reforms first.
Yeah.
And then once they get the economy moving, it then becomes kind of regular policy to be looking at fiscal tightening and raising taxes and stuff, because we'll obviously have rebounding inflation, et cetera, and so it'll be more of a natural play at that point to be looking at budget repair, et cetera.
Yes.
So,
and you would think, I mean, you're right, it makes sense, and you'd think that you'd sort of say, look, let's try and get the more contentious. Let's try and get the infrastructure and the tax hike stuff done. The infrastructure and the Bidencare stuff done before their 2 years, and then you get the midterm elections, and then see how things go and try and get these other ones after that. But I guess all I'm flagging is if that's not the case, if you see them doing the opposite, that's quite a negative for markets. If they don't.
Yeah. Well, I suppose they may try and package it all up in a way. Like, for instance, coupling infrastructure with tax hikes as a way of forcing the agenda through. But you're right, that might prove to trouble markets a bit more.
And obviously,
the other thing though is,
sorry, fellas. Yeah, I was just going to say. Well, obviously, you would have thought the pandemic, or easing the virus issue that they've got, would probably be first and foremost. Obviously, I understand infrastructure is a long tail sort of investment, so you might as well try and find the money now to get it all happening. But and you mentioned there Bidencare, which I suppose is what the take on the Obamacare. Well, maybe I'll let you go into that one first, Damien. But
yeah, I mean, right now the 1.9 trillion proposal it doesn't have any infrastructure in it.
Yep.
Like we can go through what's
jump into
down
that
here.
Yeah.
Most of that is COVID repair.
Right. Yep.
That one. So that's your typical stimulus, and then you roll out as you put it, the long tail stimulus next for infrastructure to accelerate yourself into a new cycle.
Okay. Yep. No problems. Final one there, Damo, Yellen and / power dynamic.
Yeah. So the other sort of big positive from the stimulus side is that Janet Yellen is looking like going to be the Secretary of Treasury, and her prior role was heading up the central bank in the US, and so I guess she knows a bit more about the things that are possible, and I think she'll work a lot closer with the central bank. And so I think you'll find there will probably be policies which may not have Senate support, but they have ways of being enacted through using relationships there with the central bank to effectively get the similar goals. Without having to get to votes, and maybe that's something along the lines of state or municipal debt in the US. Whether there's more support in terms of that they can roll out policies to say, okay, we're going to do this infrastructure, and we're going to have $1 trillion of state and municipal borrowing to do it, and there's some sort of central bank support or something that could be done without needing to legislate behind
MMT,
that.
in other words, although it will never be labelled such.
No. So so I guess that's we're treating that as a glass half full. Maybe we're being too optimistic, but certainly I'd say there's a strong potential for something to come out of that whole Yellen having been in both chairs and knowing the Fed and what they can do.
Very good. All right, we'll jump across to the coronavirus relief table. Fantastic table here. Looking at the columns, it's just running through the various proposals and what's gone through.
Yeah, so this is just, I guess, probably the key ones are those last ones. This is a Goldman Sachs one, just sort of talking about what the latest Biden proposal is and where it's going, and then they've just sort of put some estimates about what they think could be negotiated. So they've sort of said, okay, well, what happens if it goes from 1.9 trillion to a 1.1 trillion, and where's that where are the most likely places that would go through unchanged, and which ones will? So, for example, business assistance is probably going to fly through fine because that'll have a lot of Republican support, but other ones like health insurance may not. And so
Sure.
that's just sort of their guess at which are the areas that could where you could see that negotiation.
Mm-hmm.
And more importantly, putting in perspective of just to give you an idea of GDP. So 2020 GDP. So
it's incredible.
It's you keep in mind that it's a depressed number that 2020. So it probably would have been better to use 2019 GDP as a more realistic, but it is a significant portion of GDP. So let's call it 5% ish of GDP. So a very strong stimulus to the economy, and especially an economy which is, I guess, learning or has either learnt or is at least learning to deal with coronavirus and the various shutdowns. I think there's most places are finding that certainly there's some service industries that suffer, as a second or third shutdowns happen. The service industry suffer, but I think there's a lot of companies out there who now have systems in place to deal with it, so that the effect of shutdowns or of an ongoing coronavirus issues are nowhere near what they were when it first hit, and nobody was expecting it.
Sure. Yep. 5% of GDP. I know we'll chat around this a little bit later, but that's got to be pretty US dollar deflationary, I would have thought. 5% of GDP, new money. David? No?
Yeah, I think the base case is for two reasons: ongoing US dollar weakness. I mean, the two reasons. One is the one you mentioned, just debasement. The second is the US dollar tends to fall when you get into new business cycles, by virtue of the movement of global capital, which seeks safe havens during difficult times, and then flows back outwards from the centre to the periphery when the cycle comes good and people start looking for higher returns. And so money moves from the US to emerging markets and other jurisdictions, so it tends to drop the US dollar. So yes, I think at the moment, yes, it's US dollar bearish. I'm expecting another probably 10% or so down in the US this year, US dollar.
Sure. All right. We'll chat about that a little bit further in the show, perhaps.
Sure. Might get some questions on that as well.
Yeah, absolutely. Anything left on this chart or this slide, Damien?
No, I think so. But I think So I guess the overall message is really just that there's certainly stimulus coming. We really don't know how big it's going to be, but it's at the just the first round of it. If it gets halved, is going to be 3 to 5% of GDP, and and that's without any infrastructure, which is likely to be. I would think the infrastructure, while the infrastructure will take place over a number of years, I would expect a similar size, at least, of infrastructure to be proposed.
Yep. So that's really what we're talking about, sort of an initial sugar hit of stimulus to sort out the virus, and then followed up by more sugar over the long term in the infrastructure.
Well, more healthy, maybe just, sweetener.
Sweetener. Okay, fair enough. We'll jump across to the US economic environment.
Yeah, so stimulus coming, but I just wanted to frame it as to where we are at the moment in terms of the US economy, and where you can, where there's scope to expand and where there isn't. So we haven't really got heaps of time here to go into the full details, but our take of the last sort of 10 or so years has been that we've really been facing this weak demand environment, and how we've got around that is by doing lots of borrowing. And so we're not expecting, and so the economies that we had before the coronavirus were only sort of weakly positive because they're actually getting out there and borrowing lots of money. And so we're expecting that's not going to change suddenly because of the coronavirus. If anything, it's worse. And so we're still going to need to see that debt to keep ticking over. The corporates don't have a lot of scope. There is already a fair bit of corporate debt out there. Governments don't, and even the US government, there is lots of scope for them to increase their debt quite considerably, and consumers also in the US, not as much in Australia. In Australia, we're pretty tapped out, but within the US, there's a fair bit of scope to increase debt, and it is worth noting though. This is all about the distribution. So if you found that nobody, the bottom 50% of people didn't change their debt at all, and in fact maybe they saved a bit more money, but the top 50% went out and doubled their debt, like that would significantly increase the amount of debt that's in the US. So it doesn't have to be. We're not talking about a consistent increase right across the whole board. It's basically saying, well, if the virus, if you can get the virus winners, the pandemic winners, to get out there and start borrowing and investing, then there is scope for consumer debt in the US to increase. So that's the debt side. There's going to be catch-up growth and catch-up inflation over the next 6 to 12 months, just because the downturn was so low that both those numbers, you're going to be reporting some quite good numbers within the growth and inflation. It's just a question of, and they're not going to be back to where they were in prior cycles. And the question is, do markets then take those growth figures and the inflation figures and extrapolate them out going forward? And that's the real key about this. Can we get a new cycle going? So when we start seeing inflation prints of 2%. Or 3% even, because they're cycling very weak prior numbers, does the markets then go, that's it, inflation's back, bond yields need to shoot up, which then crashes equities and reduces the government's ability to get out there and borrow more money? Or is this going to be, are all the interest rates just going to be squashed by the Fed, and and you're more likely to just go through what we've seen for the last few years. Is just that really slow growth, way too much debt sitting within the system, and just trying to force feed the market more debt to try and force feed the economy, more debt to try and keep growth going. Might punt that back to you, Dave, for your thoughts.
Yeah, well, I just popped down onto the next couple of pages for my view on this. Basically, as you say, catch-up growth is this probably falls under that title. US consumer and households are just in spectacular good health, remarkably enough. I've got two charts on here. One of them is personal savings rate, which is around 88%, way above where it's been for many years. And there's more than $1 trillion in excess savings, which can be run down as consumption over the next year or two. And asset prices as well are all through the roof for households. So the wealth effect there is also huge, both in terms of stocks and property, because we've had this liquidity-driven asset price boom. In terms of the catch-up growth, the potential there for a US consumption boom is pretty epic, and I think that's going to be very strong. And then tipping into that, if you go over the next page, you'll see another chart just on US wholesale inventories, and you see they're quite low, and so you may well have a circumstance where demand suddenly takes off as the virus is contained by the vaccines, and I think mid-year is a pretty good sort of base case for this. And then the supply side finds itself quite short of goods. And so you're going to get a big catch-up boom on the supply side as well. So what it adds up to is just an awful lot of output for the next 12 months. Now,
actually, I might just take one step back on the inventories for anyone who is confused by that part. Is basically it's the part where what we're effectively saying is shops and manufacturers have been running down what they have in their inventories and just selling what they have on the shelf, so to speak, which means that if you do get demand comes back, all of a sudden the shop needs to go, well, I'm actually running low, so I need to order my ordinary amount, plus I need to order an extra amount to refill the shelves for all the goods that aren't there. And so that's that's where you get the double effect of, and so it's a bit of a whip appearance where the growth that can come through for them is actually way stronger than.
This is very typical of any post-recession environment, I might add. This is the case of when pent-up demand arrives after a recession, and typically the supply side has run down its inventories, and this is kind of the trigger that generally kicks off a new business cycle. So that's quite promising. The fly in the ointment, as it were, as mentioned by Damo, is we're going to see some pretty decent rebound in inflation just on base effects. That is weak inflation last year. And if markets get it into their heads that we're into some, new exciting inflationary environment, perhaps driven by endless stimulus or MMT or whatever bogey they come up with, then that is obviously going to present a risk to high asset prices, because they'll start to mull, via higher bond yields. Markets will start to mull the Federal Reserve being forced to raise interest rates. I think the Fed has actually gotten ahead of this quite healthily. Like the RBA has done here, they pretty much shifted their control function on lifting interest rates, or response function, from simply breaching a certain inflation threshold to more average inflation over periods. And so they've pretty much explicitly said they're not going to hike until they've seen 2% inflation. And that's their particular brand of inflation, which is much lower than just about everybody else's. So it'd be core inflation in effect. It'll need to be at 2% for a year before they'll be hiking. Now, before you see that, there may well be talk of tapering, etc. And this is where we come to what is a very delicate balancing act for the Fed, which is, they've blown liquidity bubbles effectively in all asset prices, both profits, bonds, stocks, and property. And there is an economic boom coming in part on the back of that, but mostly on the back of just the getting on top of the virus, which will hand off these high asset prices to profits. And there is a kind of window for a year or two where there's scope for those high valuations to be rationalised and to come down via a profits boom. But the Fed's got to avoid any backup in yields for that to transpire. If we do get a backup in yields, then obviously that's a big risk for asset prices coming off via price rather than by multiple.
So David, when you say a backup in yields, just give us an example.
Just the bonds start to sell off on the prospect of imminent inflation, and yields start to rise, and that's generally a signal that the Fed's going to have to hike as well. I personally think most of this will wash through before it's a problem. That the Fed is more or less ahead of the game on this by recharacterizing when it moves. But there is always the risk of either policy error or inflation gets a little higher than markets can confidently contemplate. And so, that's kind of the key risks to this handoff scenario.
Yeah, and you can see that where if we got, say, the oil price, took a jumped up, and we've sort of got this double effect of the we've got this weak, we've got the low base effect that Dave was talking about, where the price of a good fell from $100 back to 90, and now it's back up to 95, and so measuring it from the 90 to the 95 is actually quite a steep increase. And if that's happening, and markets at the same time as you got the oil price, maybe markets are looking, and we might print some really high numbers, and markets might suddenly panic and decide, inflation's here, and because there's lots of people saying that all the money that's being printed will inevitably end up in inflation. It hasn't been the fact for Japan, hasn't been the fact for any of the countries trying to use that same method to recover from the financial crisis, but there's still plenty of people out there warning of it, and so they could carry that, and then the momentum, people jump on the same trade, and you can see that push higher. But the flip side is, if it does start happening, and markets do start panicking, we do expect the Fed to step in to try and keep rates lower.
Yeah.
So,
the one thing the Fed should be able to do is control long rates. It's the one thing it's done now for many years. When it puts its mind to it, it is a problem it can solve.
Yes. Yeah, okay. Exactly. The other, and we spoke about the latent. So we spoke also. I spoke only very briefly on one of those previous slides about the latent bankruptcies. Though that's the other dark cloud hanging over the markets is. And it's sort of coming back to that same view we've got about saying we're not living in a capitalist society at the moment. It's all we're talking about is how much the government's going to spend to try and keep this thing afloat, and keep liquidity sort of bouncing around the markets. And then also, are they going to keep allowing people not to pay their mortgages, not to go bankrupt if they've for smaller companies, and not get evicted from homes for not paying their rent. And so that stuff just globally seems to be keeps rolling over. How we extract ourselves from that, if it's done nicely, if there's a nice sort of, I don't know, some sort of gradual fade out, and they manage to,
or there's a plan, I guess, essentially. Yeah.
The danger if there's a sudden stop and all of a sudden we have a rush of bankruptcies, then that could be an issue as well. I mean, allowing that to sort of just to have zombie companies and zombie consumers there is not a good long-term growth prospect. And it will weaken that sort of medium-term growth. But I suspect most politicians are now fully all in on the we'll just keep ignoring that problem. It hasn't blown up yet, and we'll hope it doesn't blow up.
Yeah, I think Biden already extended all of the rental moratoriums, didn't he, till September?
Yeah, he's done something with education as well. He's done their loans, student loans, I think, as well, been pushed out to September. State borrowed loans, federal borrowed loans.
Yeah, that's obviously another possible stimulus option as well. They've been talking about lifting student debt burdens and things.
Yeah, that'd be a big one, I think.
It would.
That's giving money to the right end of the market.
Yes and no. I mean, there is a bit of a class issue with that, simply because, there's a fair bit of good research that indicates that the biggest political division in the US right now, and as reflected in inequality, the same demographics, is education, tertiary education. So by lifting student debt, you're potentially only boosting
the wealthy
democratic support by and large. You're not actually addressing the working people's problems those that have rallied to Trump. So you can actually see it as unfair to do.
Interesting. Yep. Okay.
And from a generational perspective, there's some fairness to it, but from within generations.
Yes, exactly. Yeah. So I just wanted to add one more thing, I guess, to that discussion on inflation and the Fed, the US dollar, etc. We're really only talking 2022 here for these dynamics, by and large. Although I think the scope for the US boom to tip into 2022 is pretty good. But Chinese exports are going to be very strong off the back of all of this, as will European. And that will afford China the opportunity, assuming that the virus remains under control there. Of course, that's probably the assumption that underpins all of this. But I think China will tighten very quickly this year and move back towards structural reform rather than stimulus to drive its growth. And so I expect by the time we hit 2022, China to be slowing materially and the yuan to be falling, and so that will change these dynamics very quickly from inflationary to deflationary. So unless I see something really outstanding in terms of US stimulus with a pile in from, say, Europe and other countries on like a big new Green Deal of some sort with trillions and trillions, 10 or 20, I actually think that the base case will be a resumption of lowflation relatively quickly and early in the cycle.
Okay, very good.
Yeah. And the dangers. So the big dangers, I guess, from that is so there's a bit of an issue about timing in terms of how you're timing it. We're basically make the assumption that central banks and governments have got your back at the moment, and they're going to keep pumping money into this until at least until the sort of vaccines are well established. And so it means if we're not living in a capitalist society, what are markets going to do while they're backed by governments and central banks? And profitability has been quite good, like for companies. We're just starting to get into reporting season now, and but even from the last reporting season, there is a significant number of companies who are coming in reporting saying sales are down by 2, 3, 4, 5%, but profits are up because we
cutting costs,
slash and burn with costs, and debt costs are down. Whatever debt costs are down as well, and so so that profit boom Dave was talking about is not guaranteed, but it's certainly all the signs are to date that's going to help start supporting some prices as well.
Just on that, so dividends, I guess, globally, or maybe just focus on the US today. Not known for high dividends as from an equity perspective anyway, but obviously with raging price to earnings multiples, it's got to be hurting the dividend. But do you think that the increased profits are going to help keep some semblance of a reasonable return, although it's not much?
Well, US divvies have been absolutely belted.
Yep.
They basically halved over the year.
Yep.
From 3% to about 1.5% at the moment. So.
Yeah, but if you took away the and if you add in the buybacks as well, then it's fallen even further. but I think that's where you're seeing, a number of companies that were not that affected by the coronavirus, but actually put in lots of procedures, whether it was firing heaps of middle management, giving people pay cuts, or at least pay freezes, who are actually sitting pretty profitable at the moment. And they were very worried, which was why they conserved all this. They didn't pay their dividend or didn't do their buyback. And a lot of them are looking and going, well, we've actually got a fair bit of money. So,
Yep.
I wouldn't be surprised to see a significant bounce back in dividends, and probably more likely a significant bounce back in buybacks. In terms of buybacks are just much easier to turn on and off, I guess. In terms of if you're concerned about, look, things are looking a little bit. I'm not thinking that there is blue skies and smooth sailing ahead, but I've actually got a bunch more. I've got a bunch of cash we don't really need. Then I think companies, rather than saying, "Oh, we'll increase the dividend," I think they'll turn around and go, "Let's do a buyback." Because if in a year's time it turns out that it is some stormy clouds, it's much harder to cancel your dividend than what it is with your buyback. You just go, "I'll switch it off," and you're done, and people don't really notice.
Yep, fair enough. All right, very good. Shall we jump across to the investment outlook, lads?
Yep.
Look at
I think we're good to go.
Dancing, but near the door.
Dancing but near the door. That's right. Is the title. So I've just got those positives and negatives I've had up there for a little bit, but it's worth noting again that we're not in a free market. We are in somewhere that's supported very much by government spending and government policies to prevent bad things from happening. Because of the vaccines, we're expecting that to continue at least until the vaccines take hold, which is probably at least another 3 to 6 months. But it seems from a policy perspective, it's not like a never ending. Okay, people will never have to pay their interest ever again. It's just, oh no, we'll extend what we've done for the last year for another 6 or 12 months just to get back to a more normal economy with vaccines. So we are expecting that to continue. We're expecting central banks just to continue pumping money into the economy, and so it's hard to see markets suffering a significant pullback in that scenario. In that we expect if you do get a bit of a pullback, central banks will probably step in with more jawboning and potentially more support. And so markets have run pretty hard recently. So there is, quite potentially we're at a short-term peak, but we'll probably use a pullback to load up a little bit more. But with a view though that you still need to be quite defensive in terms of what you're doing, and making sure you've got a clear eye on the exit in case inflation does pick up, in case there are policy errors either by central banks. Or policy errors in terms of not enough stimulus, or US, the stimulus gets blocked and not put through. So, I think there's a number of issues you need to be quite cognizant of. But for us, it's been about trying to have as much exposure as we dare, with the view that that's what central banks are trying to make everyone do. They're trying to force everyone out of safe assets into risky assets. And you're certainly picking up a better yield in stocks than what you'd get in fixed income. But it's about trying to measure the risk and make sure the stocks you're buying aren't the riskiest ones within that.
Okay. A quick one, actually. Dave, yeah, I'll hand over to Dave quickly.
No, fine. That's good.
Yep. Just a quick one, though, I guess. So obviously, the things we've spoken about today, stimulus is pretty much, it's known. Whether or not it's priced in, I guess, is the next question. But external shocks, I guess, as always, we're always on the lookout for big downside risks. The virus in the Northern Hemisphere, and I was reading a bit this morning, actually, on this new strain that is sort of starting to kick off in the US, and they figure they might actually end up doubling their case count at some point before it gets better. Is that something that could turn into whether it's an external shock or a shock of some form that potentially could create some headwinds for an otherwise raging market?
Well, all the research so far has indicated that the the new strains are affected by the vaccines. So I don't expect US cases to go higher from here. I expect them to go lower. And if they take a little bit of time, more importantly, US hospitalizations will crash anyway, because they're vaccinating the vulnerable populations really quickly.
Okay.
So, basically all the aged are getting vaccinated very fast, and that's where your hospitalization trend comes from. So once you've solved the death problem, you've solved the economic problem, in effect. There'll be no more lockdowns.
Yeah. And I think that's probably the important one to note is that, as we've been saying from the start, your real constraint with the coronavirus is your hospitalization. If people are turning up to hospitals, after having had a car accident or a stroke or whatever, and can't get a hospital bed because they're all filled with coronavirus patients, that's where the problem is. But if we can get to, and countries can get to 70% of the vulnerable people are vaccinated, and even if it's only 30% of the rest of the people are vaccinated, that will take the strain off the hospitals. And at that point, if you open up your economy and it does go, the virus goes ballistic through your economy, quite possibly, it won't, even at those rates, it wouldn't fill up your hospitals. And I think there will be a certain amount of, especially in countries like the US that are quite, down to individual choice, is saying, well, if you get coronavirus, if you had the chance to take a vaccine, you decided not to, and you got the coronavirus, well, that's your problem. We're not shutting down our economy for you. Where if there's a solution out there and you've decided not to, then
definitely the case in the US. Poor old nanny state Australia may not be the case.
Yes, well, we'll get there. We'll get there later. But yeah, well, who knows? But I do think there's a as David was saying, you don't, even though there's going to be a lot of skepticism and it's been rushed through and issues, in the populations, as long as you're getting the vulnerable population vaccinated, I think it will be thrown open, and if you want to run the gauntlet, run the gauntlet.
Yeah, which is not to say that we won't get a new virus strain that isn't insensitive to the current vaccine wave. That's entirely plausible. I mean, that's more of a likely sort of black swan, if you like.
That should probably be a bigger risk in that. Yeah.
Yeah. Well, natural selection's working on that right now. So.
Yes. Yes. And it's well worth noting that, I mean, as David said, with the natural selection, like, if this virus was, when it was constrained to a few 100,000 people in China, the amount of mutations that can happen are quite limited.
Yep.
Now that most of the world has global. You've just got a global,
one giant petri dish in space. But I mean, China was out this morning, I think, saying that its new outbreak, it's identified 15 new mutations.
Wow.
So yeah, I mean, but let's not be too gloomy on that. At this stage, it's okay.
Yeah, and if you took the view that, look, you can get enough people vaccinated, and whether it's even a yearly or every second year vaccination, where it's a bit like the flu shot, just has to keep getting done, but you can keep vaccinating 70-80% of your vulnerable population and 30 to 50% of everyone else.
Yes.
That's
and hopefully you can swiftly adapt existing vaccines. So.
Yes, anyway. That's right. Yeah. I mean, that it is. Yeah, for all the problems with mutations, it is likely that whatever mutations happen, they will be able to change the existing vaccines. Even if the existing ones don't work, they'll be able to make tweaks to them so they do. Is quite likely.
And it's part of it as well, like in just looking at sort of Asia's performance against the current virus versus the Western world that sort of hadn't had the SARS, dress rehearsal. Going forward, well, maybe once most of the West actually, becomes virus trained, then, these sort of risks probably aren't as high because, the people will be used to wearing masks or washing their hands or doing all those sort of things that you need to do to limit the spread as opposed to going to
I hope you're
pool
right.
parties.
Well, I think you're right. At the institutional level, it'll be true. Like there'll be a lot more sense about how to respond quickly if there is a new issues.
And potentially there's ones. I was reading an interesting discussion about the amount of contract tracing and things that are being learnt in the contract tracing might mean that other things like say chlamydia or HIV or other diseases that spread person to person, and contract tracing is quite important. The lessons people have learned might mean that there's a bunch of other diseases that actually this is quite beneficial for. And you might keep a permanent contract tracing force which can be chasing down various things, so that if you do have a new outbreak of something, it can there's people there trained and ready to go, as opposed to everyone starting from a blank piece of paper.
Yeah, sure. Just had a question drop in actually from Sean. Thanks for your question. What's a realistic timeline of any tax changes Biden may want to introduce? Years, not months?
I would think so. But that's the danger, I guess, is that if he comes out and says, "Yep, corporate taxes have to go back to the prior rates, and company and individual tax, the highest individual taxes, that's the first thing we're putting through the Senate, and we're not doing anything until we've got it through." I think it's highly unlikely he'll do that, but that would be a big negative as well for markets, and because it's going to wipe 10% off earnings. So, whereas I think it's more likely that if he does try and pass, even if he tries to pass the legislation as part of, say, an infrastructure bill, it'll be staged, and it'll be like, okay, in a year's time we'll raise taxes to this, and in 2 years we'll raise it to something else, and
so it won't be a shock. It'll be no.
That's what I would expect, but when you're talking about black swans and things could derail market sentiment, that would certainly be one.
Yeah. Policy risk and virus risk, probably virus mutation risk, the two big ones for shocks, I think.
Okay.
And the other one is which we spoke about already, but is that if we print some really high inflation numbers for whatever reasons, and there might even be quite technical reasons that don't look sustainable, but the market could panic on that, and we'd expect the Fed to step in, but yeah, there's a risk there that could easily lead to a fall. And at some stage, like, we do think that's probably likely in the sense that markets will need to, when things start to fizzle out and you're not seeing enough growth, markets will probably need to have a bit of a tantrum in order to get the attention of the Fed and governments to then go, okay, we need to spend more money or do something else. So, as much as that doesn't sound like that shouldn't be a 2022 story though. Not a 2021 story. Or late 2021. Sorry. Yes. It'll be 2022 story. And as much as that doesn't sound like a good way to run an economy.
That's the way it works.
It is the way we run it.
Let's wait for markets to have a tantrum and then work out what to do. That is what we expect for the moment. And given so much of it's all dependent upon government stimulus and central bank stimulus.
Yep. All right. Very good. Any more, gents, or we can finish up there? We're pretty close to time.
No, that's good for me.
Yep, I'm good.
Yep, wonderful. All right, well, look, thanks for your time today, fellas, working through the Biden boom or bust, and I think this will be a great topic to track how it's all going over the next few years, and as he sort of starts to right a few wrongs of the previous administration. So thanks again, guys. We'll jump across to our viewer question of the week. Is the US headed for fascism? Feel free to drop in your answers in the chat box below, and maybe you can guess which one of us put that question up there as well. But anyway, for our regular viewers, but I'll leave that one there, and always look forward to hearing your thoughts. Coming up next week, we're joined live by Managing Director of Global Mining Research, David Radcliffe. David is over 15 years experience. Not Harry Potter. I'm showing what I've been up to over the holidays, tracking through some Harry Potters with my kids. David has over 15 years experience as a mining analyst and 5 years in the industry with North, Homestake and Newcrest. Technically qualified as a geologist and a geophysicist, David is joining us to cover off on the prospects, pun intended, of the global commodity markets, including lithium, copper, and of course gold into into 2021. So tune in next week, Thursday the 28th of January at 12:30 p.m. for our chat with David in the deep dive into global mining. So thanks to all of those who've watched in live for another great episode, and also to those who've asked questions. I hope you've taken away some great ideas, and if you haven't already, feel free to click like on the video to give us some feedback. If you'd like to see more of our content, head over to nucleuswealth.com/content to stay up to date with news from us. Follow us on social media. And finally, if you know anyone who gets something out of today's episode, let them know about it. Share with a friend and help our show grow. Thanks again for tuning in from myself, Tim Fuller, and the team, and we look forward to catching you at the next one.